I'm Motley Fool Canada Senior Analyst Nick Seipel, and this is the 5 Minute Major, here to make you a smarter investor in about 5 minutes. Today, we're discussing dividend growth investing. We'll discuss why, for long-term investors at least, dividend growth is more important than the starting dividend yield. And we'll close with two Canadian dividend growth stocks to consider if you're looking for passive income. My guest today is Motley Fool Canada Chief Investment Officer Ian Butler. Ian, thanks for joining me once again.
Great to be back, Nick. A couple weeks away, and we're good to roll, though.
So, talking about dividend growth stocks today, when you're looking at dividend stocks, many investors, especially beginners, look at that starting yield and stop the analysis right there. Why is it important for folks to focus on dividend growth?
And I think you used the key word in the intro, long-term investing. And indeed, over long periods of time, studies show that, and I'm talking decades here, studies show that companies that consistently grow their dividends generate higher total returns with less volatility than companies that maintain static dividends, cut their dividends, or pay no dividends at all. And it's kind of when you think about it a little bit, the logic sort of flows that dividend growth is actually a sign of a healthy growing company with rising earnings, businesses with pricing power, strong balance sheets, disciplined management, and traits that you just don't find in companies that are either struggling to pay a dividend or cutting their dividend. And I think it's important to realize too that people see that initial yield and they sort of get excited when you see 6, 7, 8% on a stock. But in fact, a stock yielding 3% but growing its dividend 10% annually, for example, you're going to double your income over in just over 7 years with that situation, rather than just maintaining that 6 or 7% yield with a company that doesn't increase its dividend. So I think it's very important to realize that the market is sending a signal when it puts a high yield, when you're looking at a high yielding stock. It's a signal to, in fact, stay away. It shouldn't be a company that you're attracted to. It should actually be one that you stay away from in most cases.
Yeah, so with that in mind, what's one Canadian dividend growth stock or a pair that looks attractive to you right now and why?
Yeah, we're gonna go not one, we're gonna go two, and these two companies are actually they offer somewhat of a best of both worlds situations. They current offer a pretty attractive current yield, and they've got a long history of dividend growth. These two companies live within the mighty Brookfield empire, and we're going to start with Brookfield Infrastructure. The ticker on this one is BIP.UN on the Toronto Stock Exchange, and excuse me, Brookfield Infrastructure is a leading global infrastructure company that owns and operates a high quality portfolio of regulated assets and long life contracted businesses. So it's got a portfolio that's filled with utilities, transport like toll roads, midstream energy assets, and data centers as well across North and South America, Europe, and Asia Pacific. So across the world, a vast portfolio. And the company currently offers a dividend yield of 5.2%. More importantly, though, it's grown its dividend at a 6.3 average annual rate over the past decade or so. This has resulted in a 218% total return over that decade or so, and that handily beats the S&P TSX Composite total return of about 155%. Other company that we'll mention here is Brookfield Renewables. So a cousin of sorts to Brookfield Infrastructure, but very different assets within Brookfield Renewables, as the name suggests. It's one of the world's largest public owners and operators of renewable power and decarbonization solutions. So we're talking hydroelectric, wind, solar, and storage facilities that span across 5 continents. So similarly, the current yield for Brookfield Renewables is 5.9%, and the company's dividend has grown at an annual rate of 3% on average over the past decade, so about half of Brookfield Infrastructure. But its total return is quite similar at 220%. So another one that's handily beat the S&P TSX Composite, and just an interesting smattering of assets across both of them to put in one's portfolio. All very important, critical assets, and it's just an easy way to blanket a vast array of renewable and infrastructure assets with two simple holdings.
Yeah, one other thing to mention as well, both of these companies, often their contracts for these types of important infrastructure indexed to inflation. And so their payments they're getting from their customers going to increase in line with this high inflation environment we've seen, which helps support that growing dividend over time. Two great companies if you're looking to buy today, but also to hold for years and years on into the future. Ian, thanks so much for joining me for this edition of the 5 Minute Major. Hope to see you next time.
Awesome, Nick. Thanks.